you see a lot of the time that Ethereum specifically is argued to be valuable because it is both this ultrasound money, the store value, but also this kind of gas token, this money for this new internet. And those things are, in our view, just diametrically opposed to each other. Can't have one or the other. So I think that whole ultrasound thing, especially now that it's back to inflationary, that has really, we've lost that kind of piece of it. I understand the argument that Ethereum as like this internet state, this internet nation, and this internet money. Sure, like the internet's huge. There's a lot of transactions that can happen there, but you're not going to convince me that's worth more than the euro or the Swiss franc. And so if you actually look at the GDP of Ethereum, if you actually calculate how much Ethereum is needed or ETH is needed, the quote unquote, the price you would get is about 1/1000th of the actual value. 1,000 times overvalued compared to how much monetary stock is actually needed to support Ethereum's GDP.
Kevin Mills is head of research at Triton Liquid and FJ Labs, a Princeton grad, and lead author of What is Ethereum Worth?
A sharp, data-driven critique that questions the current market value of Ether the asset.
And in that world where you have the cost to transact trending to zero, the time to transact trending to zero, including asset swaps, so USDC to Ethereum or ETH, for example, and then the actual interaction with ETH as a gas token, as a payment mechanism abstracted away, it's really tough to make the argument that people are going to be stockpiling hundreds or thousands of dollars of ETH when they only need a couple of cents worth to transact hundreds of times. And so with Ethereum, the big problem has been that to me, that doesn't suggest that retail users, and then really where the ban will come from is businesses, they're not going to sit there on tens of thousands of ETH in order to pay for a 1 cent transaction. And so you're not going to have just this huge buildup of these stockpiles of like strategic reserves of ETH. They're just not necessary in an internet native capacity because everything is instantaneous and free.
What are potential ways, to strengthen the Ether asset?
But it's really the high value applications that you want people to pay up for. And then that's where you capture that value. Whether or not they can get this execution back from L2s, that cat might be out of the bag. And that's really the big problem here.
Hey guys, welcome back to Less Noise, More Signal. Yes, today we are going to talk about Ethereum, and that's going to be quite interesting because I managed to bring on a really interesting guy, Kevin Mills. It's really cool to have you on. Maybe you can quickly introduce yourself. I think you work for a fund which is called Triton Liquid, but maybe you can just take it away and quickly tell the audience who you are, who the fund or what the fund is about, and then also maybe why you're equipped to talk about Ethereum in the first place.
Sure, that sounds great. And thanks for having me on. So as you mentioned, at Triton Liquid, so we are a liquid token fund investing specifically in blockchain assets, digital assets. And I am the head of research at the fund and, one of the investment partners. And so my background, it's, traditional finance. I was traditionally, trained in economics, did some institutional asset management, managing multi-billion-dollar portfolios, and then went to the other side of the pendulum and did deep tech strategy stuff out in San Francisco. And so that's like advising on quantum computing, on AI, and just helping kind of startups or startups within businesses really develop out their tech plans that way. And so applying all of this to digital assets and to blockchains themselves, it's been fascinating to watch over the last few years how a lot of people are excited about the technology, and for good reason, but there seems to be a breakdown in terms of how you actually value these things, how you actually assign value to the tokens themselves, and why, sometimes those aren't necessarily the same thing in terms of how a successful network is versus an asset. And so part of what we do, and that's really our bread and butter, is finding the assets that have true value accrual, that are true businesses built by good teams, that are reasonable investments to make in a hedge fund structure, versus kind of what has traditionally been the play of more of almost a retail pray and spray, if you would, where things kind of start departing from traditional value. And so at Triton, we take a fundamental approach. We spun out of a venture capital firm called FJ Labs. So we really apply a venture lens to a lot of this with kind of an equity market overlay, if you would. But then we also have a quantamental approach. So because all this data is on chain, we're able to build out our own data infrastructure, track all the things that we care most about. So we run regression models against all of these different verticals within the space, and we can track um, the key value drivers within each type of vertical. And so that's how we want to look at this stuff. And that is really what led us to kind of entering into this question about what is Ethereum worth, and trying to kind of put, add our voice to that conversation.
Yeah, that's great. Yeah, it's exactly this article that you mentioned that I think you wrote a few months ago. I guess it's been quite a while since you wrote it, right? It's called "What is Ethereum Worth?" essentially, and I mean, I find it so fascinating because it's a question that's on everybody's mind nowadays, with Ethereum just sort of underperforming the entire market, I guess, and especially to Bitcoin. When you compare it to Bitcoin, the ETH BTC pair is like the most watched pair, I guess, nowadays in crypto. And obviously, lots of time you have like a lot of tribal like bashing. You have like the Bitcoin maxes shitting on Ethereum, and then you have the other ones like the Ethereans, vice versa, shitting on Bitcoin. And obviously it's all sort of ideologically driven and not much value in it. And your piece is really like the opposite. It really is like well founded. It's got great arguments in there, and it's really making the case. At least that's how I understood it, and you can correct me if I'm wrong. But it's like, okay, Ethereum might be an interesting technology, there's a great innovation, but the problem is really with its asset. So like the blockchain can be great, but at the same time, this doesn't automatically mean that the asset, the token itself is just valuable just because the blockchain is great in the technology. And so that's what you sort of argue in the paper. You go into a lot of details, and that's what I sort of want to cover today as well. But is that a fair assessment of the paper that you wrote?
Yeah, that's exactly right. And so if you look at Ethereum, what it's done, how disruptive it is, and how excited people are about what it can do, what blockchain can do, right? A lot of that you can ascribe to just what Ethereum has done, right? And so in a certain context, our paper is really like complementary towards Ethereum and the community and the developers, because that's why we're focusing on it, because it has been so successful. But at the same time, if we're looking at this as an investor, we need to rationalize putting money to work in terms of all the opportunity costs of any other investment we make. And if you look at ETH, the asset itself, that does not necessarily translate to the success of Ethereum, the network. And so, and we go into, and I'm sure we'll touch on all of this, but we go into pretty good detail in the paper about why that connection has broken, and why that it's not necessarily a one-to-one mapping. And where if you do look at these blockchain ecosystems and the protocols, how you should try and find that value.
Yes, that's a great assessment. One thing why this paper struck a chord with me as well is because, like, you reference a paper or an article that's been written years ago. It's this great article by John Peffers. I think it was like the original article where he was sort of elaborating why the native token of a virtually any blockchain is likely to be a fundamentally poor investment in the long term on a risk-adjusted basis. And so maybe if you could elaborate the sum or summarize what the main point or the most crucial points were that John Pepper made in his original article, that would also sort of be great.
Yeah, and I recommend for anyone that hasn't read that to take a look. So he wrote the paper back in 2017. So really kind of the first, if you would, public bull market for these assets. They really put it on the map for a lot of people. And when he was looking at this, so just for a little context, his background, he's McKinsey, KKR, so very much a traditional investor looking at these things with a 5-10 year outlook. And he was looking at these and just could not, based on competitive dynamics, based on just how open source protocols operate, how limited moats there are, the ability to fork, the ability for developer communities to move between chains, and just the role that he saw them playing in terms of being more of a back end infrastructure akin to a database or any cloud infrastructure. Why that necessarily makes it difficult to underwrite on a 5 or 10 year horizon, especially at, given the risk of these things, 40% multiple. And then given the competitive dynamics, how do you choose, how do you understand which one to actually make that investment in. And then the risk it was just so high, and the competitive dynamics just made it to a point where it's for someone who wants to underwrite this, like based on, cash flowing assets that you can actually, trust and value, why that's so difficult. And he really kind of broke it down into two ways to look at it. Right? The first is there's going to be some non-sovereign store value. And I think everyone knows, like, Bitcoin has at the time was the front runner, and it has only really strengthened its position as that. And so he kind of laid that one out as there's really only one need for one gold. And much like that, there's really only a need for one digital gold, right? And so Bitcoin has kind of taken that role in this simplicity. It does what it does. It sits there. You can move it, but that's it, right? Um, then if you switch to these smart contract platforms, which is kind of the second piece, that's where he really just kind of almost, I don't want to say toss up his hands, but he's like, for an investor to try to underwrite these today, that's just incredibly difficult. And that was really what he got into. And we can touch on kind of all the pieces that of why he thought that was the case, but it was really just that as abstraction happens, as these things proliferate, and a lot of these tokens are really used as a gas payment. So it came to like a cloud compute credit if using Amazon AWS. Why that doesn't necessarily mean these things are going to be worth hundreds of billions of dollars. And at the time, people were calling for Ethereum to be hundreds of billions and trillions of dollars. And that just didn't resonate with him, and he laid out why. And so we wanted to just revisit that because it seems a lot of his arguments kind of have been lost over the years. And when we put this out, was at 450 billion, like, all right, things are getting a little out of hand again. And so we just wanted to revisit some of his arguments.
Yeah, that's nice. Especially like some of his takes aged quite well, if you look in hindsight, because I remember reading it as well. And one thing that stuck with me was really that he was arguing about the dilution of value that would be happening through all the forks, and then obviously through the further fragmentation that was happening, and maybe Ethereum wasn't forked in that way, like really forked, when it comes to the code base, but it was really copied by so many other layer ones, I guess, and then also the fragmentation that we're seeing in its entire like layer 2 space and beyond. So I think that was a point that already back then when I read this was like, okay, this sounds really interesting, and if it were to play out like this, and obviously that's was also already back then the case, like, yeah, we have to scale that system, we have to kind of make it more performant through this multi-layered scaling approach, then yeah, he kind of foresaw that this is just going to end up like this. So that was a really interesting point that he carved out, so to say, right?
Yeah, no, that's exactly right. If like he might have assumed it'd be just more copy paste of Ethereum itself, but as you just mentioned, right, you have Solana, Sui, Aptos, you name it. There's hundreds of dead L1s out there. A few have emerged as competitors, but then it's really through the L2 space that a lot of that value accrual that would have gone to ETH mainnet itself, all those EBM L2s have just kind of cracked open, stolen the users. Let's say that they've transitioned the users to those chains, and that's really been that dynamic that he was forecasting there.
Yeah, exactly. No, I mean, also, given the fact that my show is called Less Noise, More Signal, I always also want to point to the signal in the discussion that we're having. And I think one thing that we can already point to, is really the fact that you said Bitcoin, it's been established that there's non-sovereign store of value. We're pretty sure about this. And I think the entire space is nowadays quite sure about this, But then the thing is, it's usually extrapolated from there that everything else will sort of also have value. And then the argument is not everything in and of itself, so obviously there's going to be consolidation and stuff, and not every layer 1 is going to be valuable, but at least like the concept itself as well, and that's really something I think is still pretty prevalent among retail investors, people that I talk to, maybe even people from the audience, there's like, okay, yeah, maybe we're down now again 40%, but don't worry, it's going to go up because it's a long-term play, that's what you hear. And maybe that argument is maybe true with Bitcoin because it has this sort of niche that it's now has carved out for itself, but and that's something I read out of your article as well. This is not necessarily true with all the other things. It doesn't mean that nothing is going to have value for sure, but it's just like, it's not this easy shot, like gunshot or shotgun approach that you can say, yeah, just hold on it for the long term, and yeah, it's all going to be valuable, right? This show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL.
Yeah, no, that's exactly right. So the days of just buy a basket, hold it, and you'll make 10x, those are over. And as the space matures, and we've kind of really hit the edge of the retail driven market, and it's now transitioning to the funds, the institutions as the marginal buyers, and they're going to apply a much more, I guess, thorough lens, if you would, and really have to underwrite and justify anything that's claiming to have value in the first place. And so that store value piece that you mentioned there is interesting, and you see a lot of the time that Ethereum specifically is argued to be valuable because it is both this ultrasound money, the store value, but also this kind of gas token, this money for this new internet. And those things are, in our view, just diametrically opposed to each other. You can't have one or the other, and that is still very much an argument held out by a lot of the community. But if you just kind of think through what that means in practice, it doesn't make much sense. And I think that's really the first place you can start teasing these things apart. And then at that point, we can touch on why, as money, it's definitely not worth 400 billion. And from there, we can get into kind of more the productive aspect of the internet and the cash flowing thing. But
No, exactly. That's exactly what I want to do. But maybe just one last like point on this, because I also work in a bank, which is sort of focused on digital assets, and so I get to talk to a lot of other institutions, that are in the digital asset space nowadays. And just because you said like institutions are coming along and they're maybe are going to apply a more rigorous or more thorough approach to this, and I would believe this as well, but from what I'm seeing currently, I think it's not like true for every institution, because there's still a lot of like passive ETP providers, who are going to have an ETP on Ethereum and stuff like this, and all the other layers, and they then approach this by looking at, oh, the blockchain is really interesting, the technology, but they never make this sort of leap of faith for this thing that you did in the article, where like, okay, we need to look behind the curtains and see if there's really a connection between the technology and the asset. And so even to the extent that like the institutions are coming online, I feel like not everyone has figured this out yet, and that's why I also consider this article to be so essential and important.
yeah, and that's fair, right? But if you think of these assets, these networks, these aren't your traditional equity, and so I think there is a very steep learning curve, and underwriting process that a lot are going through. And then there's also the question of access. So there's, right, Bitcoin, these ETPs, these ETFs, easy to buy. That story is easy to understand for a lot of these buyers. Digital gold, okay, I get that. Whether you believe it's a mix of tech and gold or whatever that is, or what timeline you're operating on, it's a fairly easy story there. Once you get into Ethereum, and then now there's a flood of these ETPs coming to the market. Solana, you got meme coins coming, you got Cardano, you got Litecoin. There's just so many of these things coming to the market. I think up to now, it's largely been a point of, if you bought Bitcoin and ETH, you really bought 70% of the market, and it was, the ETH acted as a bit of an index against smart contract development. But now, as all these other ecosystems are developed outside of that, and these institutional products are coming where they don't have to buy on chain, they can hold through their traditional custodians, through the banks. you're going to probably see a little bit more dispersion there in terms of where they're actually looking for value versus where they're just kind of buying to hold the market. Um, and in the US, you see it a little bit just how successful the Bitcoin ETFs have been versus, frankly, how poor the Ethereum ones have done. And I think you're starting to see some of that in that they're looking through this. It's at 400 billion or 250 billion now. And there's just nothing to justify that outside of a venture bet. But at 250 billion, that's it. I'd rather take OpenAI right now, I think.
Yeah, great. Yeah, that's a great one. Well, I mean, I want to get into this now, So I think you already alluded to this. There's like these different ways you guys identified in the paper as well, how to look at Ethereum. And then can you elaborate on each of these and argue why you think it's not a convincing way to justify Ethereum's long-term value? I think you said about cash flowing asset, ETH as money, and then also ETH as an internet native commodity. So if we could look at all of these three sort of buckets from a high level perspective and why they're not sufficient to justify the current value, that would be great.
Yeah. So we'll start with the cash flowing asset piece because I think that's the most what, and any equity investor would want to understand first. With how these networks operate, there's really, and we'll focus on Ethereum just because of that, there's the base transaction fee on the network, and then there's the priority fee that people are willing to pay to validators to have their transactions included. And that's the more variable fee. The transaction fee is the same if it's a traditional ETH send, you're getting that same fee. The cost might change based on the cost of Ethereum or the price of Ethereum, but you're paying the same amount denominated in ETH. Then you have the priority fee, which is the variable piece that they want to get ahead of you on a block, and this is where MEV and all that starts to come into the picture. That is another vector, and then with Ethereum itself, it also has data availability, and so that is where all the layer twos pay down into it to have the data stored, and then some costs to post their data and then execution to have those transactions submitted. So those are really the ways that Ethereum makes its money as a network. And as an ETH holder, you don't get any of that. Yeah, almost full stop, right? All that the pass-through fees there, they go to the stakers, to the validators. None of that actually goes to ETH the holder, outside of the base fee, which is burnt. And so you can think of that somewhat akin to a share buyback in a certain extent, but with an ever-inflating asset, that more just serves to offset some of the dilution rather than really return value. And so as an ETH holder, you're not really seeing any of that, and you're just getting diluted daily, essentially. I know about 1% per year, so it's not a crazy amount, but that is kind of an ingrained tax that you're paying just to hold that token. So how you actually access those cash flows of the network is you stake the token. But Ethereum, and they've done a phenomenal job designing this because it is essentially all programmatic and game theoretic, but they want roughly a third of Ethereum staked to protect the network. And that should earn you roughly 3% is kind of what they've targeted that to be. And that's really where it's been at. But 3% on a 60 vol asset, really, it's tough to justify. Frankly, that's not where people are parking their money just to get that 3%, especially when risk-free rates are 4. Right. And then there's also this thing of, okay, so now that you have to stake in order to get that yield, where is the future yield coming from on this thing? So how do you actually underwrite that? You can do a DCF on this thing, but how do you project out those cash flows? And a lot of people, you'll see some of these models and they'll project value accrual from like your 19th L2 and then MEV capture on some non-existent L3s. And they sort of get really crazy with all of this, but by and large, that's almost impossible to do. And instead, it's much more simple just to look at the value accrual to actual from activity on L1 versus the margins that go to the L2s. And just look at how those things have been trending over time. And Ethereum activity is really, transaction activity on Ethereum has been pretty flat over the last few years. And a lot of people, that might be surprising to hear that actual transaction activity has been flat, but fees are at an all-time low. And that's just because all of the high value like transactions, and that's really the users willing to pay up, have all moved to the L2s. And so, and specifically in this case, really Base has taken the lion's share of this. So that's Coinbase's L2. And to get a sense of the value that they've taken away from Ethereum, quote unquote, just look at their sequencer profit, right? And that's the sequencer is really how they get paid those priority fees, right? That variable piece that we're talking about. And their on-chain profit, I was looking at this morning, is 99.5%. So they pay 0.5% of what they earn down to Ethereum to pass through to the data availability, and they keep 99.5% of that. So those margins are incredible, and just shows you how much more valuable that execution piece is versus that DA piece that Ethereum is now charging them. And then someone actually ran numbers a few days ago that it would take about 23,000 bases right now to offset the transaction fees that Ethereum had in 2021. And so it just goes to show you how massive this value dispersion is. And then trying to underwrite that now, plus Solana is a real competitor, Aptos, Sui, these are all coming, all these other L1s are coming, and it just gets really difficult to forecast any true fee growth for Ethereum.
Yeah, I see. I mean, there's that's great explanation, but there's also this discussion obviously going on, within the Ethereum community to potentially make L1s pay more, into the base layer, so to say. But do you think this would move the needle at all, or how would that work? What are your thoughts there?
Yeah, so at the margin, and a few of these L2s are I think Ethereum aligned enough that they'll be happy to absorb that. So Optimism has probably made its bed. Base probably has made its bed. And so they'll probably stay with there, and they're willing to take some of that margin compression. But I think if you look at these L2s as just businesses, the next marginal business, if they come on and they look at Ethereum specifically charging more for their DA and trying to extract more rent, and then they look at something like Celestia, an alternative DA solution that is orders made into cheaper and higher throughput, all of a sudden now, like, why would they go with Ethereum outside of alignment? Why are they willing to pay that quote unquote premium for a supposedly premium product where they can actually get a better product for cheaper if they go with another layer? So I think that the addressable market for these ETH aligned L2s is just not that big in the grand scheme of things, if the idea is that there's going to be thousands of these L2s paying into the DA.
Yeah, and it's also it strikes me as to be a really great business model. If you're sort of dependent on the benevolence and also the willingness and the alignment, that you need to sort of have in other people, that they sort of have to show towards your chain. But then, like maybe if the incentives are different, then it's just not going to cut it. So that's probably also sort of a fundamental issue right there. But yeah, I mean, is there anything else you want to add on the cash flow side here? Is there another point to make?
I think just like as a summary point, there is, despite everything we've said, if you look at it, it's still generating a couple $100 million in fees a quarter. You can access that as a staker, and that is a valuable thing with the true cash flow. And so you do get real value paid out to you as a staker. And so the problem there is it's not worth 400 billion when I wrote this, or even 250 billion now is questionable. I would say it's probably if you started assigning multiples to that, your choice there, it's probably in your tens, your tens of billions, is you can get comfortable there. So it's still incredibly valuable. Like that's a success by any metric. It's just, and unfortunately doesn't justify its current valuation.
Great. Well, what about the ETH's money then, because that's another thing that we heard. I mean, it used to be ultrasound money, but I think that's also sort of been discarded, because like reality has sort of shown its course. But yeah, what is it that you're sort of worried about there,
Yeah. So the first thing is kind of alluded to off the top is this the ultrasound money, it's both a store value and this internet money that you want to use to pay for, your meme coin trading. Those things are in complete opposition to each other. Like that's like asking somebody to spend gold in order to pay someone for a cup of coffee, right? Like, you just wouldn't do that. That just doesn't make sense. So I think that whole ultrasound thing, especially now that it's back to inflationary, that has really, we've lost that kind of piece of it. And then if you just look at it purely as a money, and this is, if you look at John's paper, really how he broke down a lot of this stuff, and it goes to the quantity theory of money, right? MV equals PQ is really what he relied on there. And through that lens is how we wanted to sanity check this argument that ETH is, worth trillions of dollars in terms of a currency. The first thing you have to think about here is how you actually compare it to a currency, a global currency. And a lot of people are tossing around M1, M2, and all of a sudden now that's trillions, right? But those are so dependent on banking systems and fractionalized deposits and all of that we made the argument that it's really the M0, right? The actual base stock money in circulation that is much more important to use. And then just we force rank that against all the traditional or your biggest currencies in the world, and it's on par with the Swiss franc. It's ahead of Canada. It's ahead of Hong Kong. Really, the only ones, if this thing were to grow into the hundreds, if it was to 2x or grow into the trillions, you're competing with the euro, the yen, the US dollar, the Chinese yuan. Like, I understand the argument that Ethereum as like this internet state, this internet nation, and this internet money. Sure, like the internet's huge. There's a lot of transactions that can happen there, but you're not going to convince me that's worth more than the euro, or the Swiss franc. And so, if you actually look at the GDP of Ethereum, which is the next piece of this, right? That's where the quantity Ethereum money comes in. MV equals PQ. How much money is needed to support an economy? That's really the fundamental question that that's trying to answer. And so in this case, PQ is the economy. So it's price of quantity of goods is the GDP effectively. And so we broke down Ethereum's GDP and assigned a pretty, I would say, generous way of looking at it, including all app revenue that happened on the L1, the L2, and then all the chain fees. And I say that's generous because a lot of these fees are paid in, in USDC or in the protocol native tokens, and they're not all paid in Ethereum or in ETH. But anyways, we kind of try to find the aggregate size of ETH's entire GDP there, and then look at how much money is actually needed. And you can find the velocity. It's roughly 7 or so. There's a few spots that track that, see the velocity. And then all of a sudden, if you actually calculate how much Ethereum is needed or ETH is needed, like the quote unquote, the price you would get is about 1/1000th of the actual value. So if you look at this in terms of ETH as money, in terms of a currency, it's on the flip side, it's 1,000 times overvalued compared to how much monetary stock is actually needed to support Ethereum's GDP.
Yeah, that's a good point as well. Yeah, I mean, the comparison to the US or Euro, yeah, obviously it might be a valuable comparison, but then as you said, like the economy that Ethereum is supporting by now, yeah, it's just not comparable, and that's why again the asset might be vastly overvalued when you compare it to this actual thing, But then to your first point, the one that you mentioned, I always felt like there's also a fundamental dichotomy, between Ethereum being or wanting, or like everyone wanting Ethereum to be a really highly used network, whereas fees will have to trend down to encourage this usage, to make it widely used. But then how can Ethereum, the asset, be highly valuable, sort of. That's also something, I don't know if you have any thoughts on that, but it always felt to me, just like if you high level think this through, there's just like these contradictions that don't add up.
Yeah, that's a perfect point, because if you think about just the nature of the internet, and everything is instantaneous, and if you look at any piece of Ethereum's roadmap, it is to create faster, cheaper transactions, and that's really the goal of any of these chains. And then another thrust of a lot of the development is abstraction. And what that means is have ETH as the back end kind of, compute credit used, but maybe having your wallet balance denominated in USDC. And USDC offers this, and they're actually trying to roll this out to a lot of the main chains that they support. And in that world where you have the the cost to transact trending to zero, the time to transact trending to zero, including asset swaps. So USDC to Ethereum or ETH, for example, and then the actual interaction with ETH as a gas token, as a payment mechanism abstracted away. It's really tough to make the argument that people are going to be stockpiling hundreds or thousands of dollars of ETH when they only need, a couple cents worth to transact, hundreds of times. And so with Ethereum, the big problem has been that it's been so expensive. But if you look at all these L2s, like you can transact thousands of times for less than $1 on some of these L2s. And that's where execution is going. The latent demand to just have this huge ETH stockpile to pay for your activities on chain just isn't there. And you require some of these transactions like 1/100th of a cent to transact. And that, to me, that doesn't suggest that, retail users, and then really where the demand will come from is businesses. They're not going to sit there on tens of thousands of ETH in order to pay for a 1 cent transaction.
Yeah, makes sense as well. I mean, one thing that I think you address it in your paper as well, but I hear some people, refer to Metcalfe's law as well when they talk about Ethereum and potentially its value to potentially even justify it. And I think, yeah, you talked about this in the paper as well. So maybe if you could quickly summarize what is Metcalfe's law about in the first place, and then also why isn't it sort of a great segue or a great way to sort of, justify Ethereum's value?
Sure. So the most basic principle of Metcalfe's law is that the value of a network grows in terms of the size of that network effectively. And most people just look at that and say, okay, Ethereum has this incredible network, therefore it is incredibly valuable. And to a point, that is true. But really, what makes a network valuable, is the ability to extract rent from that network. The internet is the ultimate example of Metcalfe's law. Incredible network, but the internet itself, how much money does like HTTP make? It doesn't. It doesn't. However, you layer Google on top and indexing that capture the value from allowing people to navigate that, and that is incredibly rent extractive, right? And that's why Google is as valuable as it is. And it's really, so the network itself is what can provide value, but where you actually get value is how you capture rent on that network. And in Ethereum's spot, if they had kept a lot of this execution, if they kept all of this and kept building and kept all these users on the L1, all these apps on the L1, that would allow far more rent capture to happen. But the most valuable piece, as we alluded to earlier, or spoke about earlier, is the priority fee, is the users. And they've explicitly pushed that away. And so that's taking a what could have been a valuable network and explicitly devaluing how much rent you can actually capture from that. And that's where you get into the issue here.
Yes, exactly. So it's really like that Ethereum's value capture mechanism, as you explained it well, are so just sort of weak, and it's intentionally so because they pushed it out into these other layer two. So that's also a great explanation. I think then we can turn to the last one. This Ethereum as an internet native commodity. Given we're already talking about the internet here, so in your paper, you're also sort of addressing this, and there you're sort of, okay, this might be the most likely point where we find some agreement, but walk us through this sort of argument as well.
Yeah. So within internet native commodity, what we really mean by that is something that, internet native, it's a native value transfer mechanism on the internet, and you use it over the course of producing something else. And that sounds almost like simplistic to say, but that's really what it is. And that's not that much different from a cloud compute credit, right? You have this token that you change into some service or some other asset. And so really that's what we think gas tokens fall most closely into, because you can use ETH to pay for access to the network, to pay for state. You can use it, in certain extents to pay for like NFTs and things like that. You can stake it to earn from the network or in any of these protocols as like collateral. So it is a productive asset on the internet. You can do a lot of things with it. and there's no denying that, right? And that's really where a lot of the value of it does come from. And we also mentioned that when people say it's like this cash flowing asset, it's really muddling these things together. But you're essentially putting your productive asset to use as a staker, and people are paying you in that asset for you to help provide a service to them. And there's a little bit of money in this in there, which is, 1/1000th of what it's actually supposed to be. But then it's also really this productive asset. And then the argument from there is, okay, if this thing is a commodity, essentially, which it is, it's fungible, it's totally fungible. How does that compare against other commodities on the planet? And this is another one that I think a lot of people haven't really looked at. So oil, hundreds of trillion, it's massive market. Gold, 17 trillion when we wrote it. It's been on a bit of a run since. But then you get Bitcoin, silver, and at the time, Ethereum. So it's already the top 5 most valuable commodity on the planet in terms of what it was valued at. And it's very, very difficult to make the argument that it should be worth more than silver, which is widely used in industrial use, has unique elemental properties that only silver has, like in a universal sense. Ethereum really doesn't have that. Bitcoin has been able to capture this unique zeitgeist. It's targeting that gold market, but it's still a tenth of the size. And then oil is just a separate beast altogether. But we're looking at this, and by all accounts, at the value it was at 400 billion when we wrote this, like that's wildly successful in any way you frame it. But the size of, again, going back to the use cases, the size of the GDP, the user base, all that really didn't justify that value in any way that we could really wrap our heads around.
Yeah, no, for sure. And also, I mean, exactly when we talk about the internet native commodity, in the end, it really boils down to, at least as I understand it, exactly what will it be used for in the end, and then obviously if we come back to this gold oil analogy, that's being made quite often as well. You have like gold, yeah, it's more like Bitcoin. Exactly, it's this store of value, where people actually keep it, and that's usually an argument against Bitcoin because they just hold it, they store value in it, and it's like it's not being used, but that's the actual usage, of just holding value in it and storing value in it. And then you have oil, on the other hand, which is sort of it's really used in the economy. It's running the entire economy if we look at traditional economies, but not a lot of people store value in oil. Obviously, that's why we have the whole futures market as well, because nobody wants to take actual delivery of oil. And so that's also maybe similar to Ethereum then, and you also, I think, say this in the paper. Then it just makes sense to think about Ethereum as ending up being this working capital on the internet, where like oil, it's probably used for some of the things if you are in DeFi, and you really need Ether, but then you quickly swap into Ether, you do your thing, and then you're out again, and you don't stay in Ether itself. So maybe if you could talk to this as well, this idea of working capital Ethereum on the internet, that would be great as well.
Yeah. And this argument follows a lot from, that money argument where, and the cost to acquire it, the cost to store it, and the cost to use it are all trending to zero. And if you think about what that means in terms of a productive asset, you can almost think of it more like at a future state, if all this development is successful, and no reason to believe it won't be, and we're getting very close already, this will be an on-demand asset you use to make an instantaneous transaction on the blockchain. And in that case, it's even less like gold or oil, because you have gas tanks and all that. You are latently storing some. With this, it's almost more like electricity. You just flip a switch, you have it, you turn off the switch, it's gone. And so it's literally just on-demand access to this asset. And there's this interesting thing where if you store $100 of it, the carrying cost of that is zero. But as you get higher, you all of a sudden now, because hot wallets, all the hacking risk, all the issues there, you actually have to store this with quality custodians, cold storage in order to protect this stuff. And that's not free anymore. That is, you're paying thousands of dollars a month, if not tens, hundreds of thousands, based on how much you're storing, where you're storing it. And then that's no longer on-demand access. You have to like NPCs, you have to have multiple people signing a transaction, and it just completely destroys the value prop of this. So the in our view, the future state is you're going to have this hot wallet of maybe 10 USDC, and the second you have to make any transaction behind the scenes, because this is where everything's going, you have this instantaneous swap um into ETH. It's on demand, paid exactly how much you need for that transaction, and then that's it. And so you're not going to have just this huge buildup of these stockpiles of like strategic reserves of ETH. They're just not necessary in an internet native capacity, because everything is instantaneous and free.
Hmm. Yeah, that's also some great points here. Yeah, well, I mean, if we now sort of try to think about ways in which we could enhance or strengthen the Ether asset. You were already alluding to some of it, like bringing actual execution back to Ethereum's main layer. Now, ignoring the fact that this is then maybe also, running into issues with scalability again, because then we're back to sort of scaling the main chain, and that was sort of maybe discarded a few years ago. But yeah, if we are leaving this aside, what are potential ways, to strengthen the Ether asset? Is it really bringing execution back, or is there other potential ways that we can think about this?
In my mind, that is the best way, is make execution on L1 a first class citizen again. We mentioned a few times, the users, the apps, those are most valuable pieces of this entire stack. And you need to bring those back to the L1. And then all of a sudden now, if you have like the transaction fee, the base fee, and you mentioned the scaling piece, push that scaling hard, right? You want that the actual base transaction fee to be as cheap as possible, but people will be willing to pay up for their specific use case. If right, snipers are this, this example, and they're racing to be the top of block, they're willing to pay tens of thousands of dollars to be top of block in a certain transaction. And so that's a very niche use case, but it shows you like people are willing to pay that much in order to get priority execution on these chains. NFT drops, everyone wants to be one of those 10,000, and so they're willing to pay. And there's all these different reasons why people might be willing to pay a little bit more, especially as you get into real trading with. And I don't think ETH will ever be able to support like HFT, but people wanting to transact, beat others in a market environment, they're willing to pay that. And the history of all these networks and Solana has really shown this, that people are willing to pay up for that. And so you want to bring that back, because the variable fee there is what really drives the value. And then all of a sudden there, you can chart a path to this being as a cash flowing mechanism. You can see cash flow growing. And I'm going to use this Solana here as an example, because they have a monolithic architecture, meaning that they don't have this whole L2 fragmentation problem. When you stake, the whole REV, which is like the real economic value that's happening on the chain, flows through to those stakers. And if you look at theirs, they go from 100 million to like 200 million to like 800 million a quarter in REV. And so if you're holding this as a staker and you're seeing that as in that token, that is value passed through to you. But that's all coming from that priority fee. And because all those apps on their chain are all on that L1. So Pump.fun is really leading a lot of that, the trading. It's all meme coins, but that's still real economic value. People pay those dollars. And so you need to kind of replicate that for Ethereum somehow, bring all that back, because as we mentioned on the top, like Base, they're just making 99% margins on this stuff. That should all be going to the L1. So that's really the main reason. Push the scaling as much as possible, make it as cheap to transact for that marginal person just sending ETH between each other. That should be no cost, but it's really the high value applications that you want people to pay up for. And then that's where you capture that value.
Mm-hmm. Yes, that's a great point as well. I mean, it's really the case that probably these application and just these consumer facing applications will be the ones that are using the technology, but that it's also they're way better positioned to sort of capture the surplus value that's being created. But I wanna sort of steelman this, or I have if some people might be hearing this, and they're like, okay, you're now sort of criticizing Ether, and it doesn't sound too good, that does that mean that the Ether blockchain is going away, because it doesn't have any value, And I think the way you're arguing, obviously, is really no, just because Ether is overvalued, it's overvalued, and that's why its value has to come down. But this doesn't automatically mean that the Ether blockchain has to go away, right? Is that the correct way to think about it? So there is some position for Ether to really play, and maybe it's an influential position in the future, but it's just going to be at a lower value when it comes to the asset.
That's exactly right. Just because 400 billion when we wrote this, or even 250 billion now is too high based on the value it's actually generating trading, doesn't mean Ethereum itself is not valuable and ETH itself is not. And a lot of the stuff in their roadmap, they are trying to really push a lot of this stuff, this scaling. Whether or not they can get this execution back from L2s, that cat might be out of the bag, and that's really the big problem here. Once you lose those customers to other L1s, to other L2s, that's very difficult to get that back. But there's still tens of billions of dollars in TVL on Ethereum. Like Aave itself has 30 billion, and that's, if you look at a US bank, they'd be top 75 bank in the country. That is incredibly valuable activity that's still happening on Ethereum. And so all this, where we're critiquing the how overvalued Ethereum is, not that it isn't valuable, because it undeniably is, and there is a spot for it. You are seeing, even though it's small, and they might, do some own chain stuff, you are seeing some major, private equity shops, you are seeing BlackRock, you are seeing people using Ethereum for some asset issuance. And so there is true value there. It's just not 400 billion of value.
Yeah. Right. Yeah, exactly. No, but then it would really be this internet analogy that you sort of made, that like the internet is huge, and it's spanning everything today, but sort of the underlying technology and the protocols, they're not accruing any value. And with Ethereum, it could really be the same, that it could really power like this internet native sort of blockchain. But then again, it would be a sort of different, because like with the original internet protocols, we had no value accrual at all, one could argue, and at least here we have some, but it just probably won't be as big as many people imagine it to be. So that's definitely an interesting point as well. I mean, we talked about lots of these points, and you were already alluding to them, but maybe what are some of the like real conclusions of your paper for the average investor, today? So maybe if we can summarize them again, just to wrap things up, that would be great.
Yeah. The biggest takeaway here is that Ethereum blockchain, these things are going to be incredibly disruptive, and especially now with a lot more regulatory clarity coming around the world, more alignment, and just green lights from regulators to allow banks, to allow institutions to actually access this. You're going to see really the value that these things can create starting to come to light. All that is to say, though, is Ethereum today, specifically, based on its roadmap, because, and if you want to go deeper on this, you can look through the paper, but how they're targeting their scaling, how they're targeting their execution, how they're trying to expand Ethereum, quote unquote, to the L2s, all of that means investing in ETH, the asset specifically, is much more difficult to stomach at these valuations. If you look at it as traditional equity, you can be reasonably sure that any profit will find its way through to shareholders. With these blockchain systems and these protocols, that direct value transfer, or that value transmission, the creation to asset holder, that's broken in a lot of cases. And if you're investing in any of these assets, Ethereum included, you really have to pay a lot of attention to how the value actually accrues to the token. You can't just take for granted because a network is going to be successful. Value is captured in a way that makes that token itself valuable. And I think that's the most important takeaway here.
Yes, yeah, that's great as well. Maybe, yeah, to finish up, I just want to sort of take this up, that what we started off with, like the thinking that sort of among retail investors, that these things are just going to be valuable, and that we just got to keep on holding and hodling, also these other tokens. So the way, I mean, you described this with a term in your paper called the crypto put. I think maybe you can sort of go into detail here as well. But then my question would be, how do you see this unfold? When does this trickle down into the market? It's probably going to be a long winded process, and not like tomorrow everyone is going to wake up and then, okay, we're all now going to sell Ethereum, and it's going to trend down. But it's just going to be like over a long period of time, and obviously the earlier you recognize this, the better it still is. And you would probably argue this process is already underway, right?
Yeah. This goes back to the point of it's now we're at that retail to institutional handoff. And I think now as more capital, more professional capital is coming in, these things will be held to a much higher standard in that regard. And you'll see that money just not reward these tokens just for existing like it has. It really comes down to, and just to kind of as a point of clarification, in 2021, there's maybe, or 2020, 2021, there's maybe a dozen real quality protocols. That was like DeFi summer. That was where, and there was a ton of free money on the market from all the COVID stimulus, and that just flooded into a lot of these things. And there wasn't a lot of discretion in what was getting bid at that point, and a very small amount of token supply relative to how much just capital demand, quote unquote, there was. That's almost flipped now, because these protocols raised tens, hundreds of billions of dollars at that time. A lot of people started building. You had a lot of people come into the space. But then when we went into that bear market in 2022, 23, a lot of teams just held off. They didn't want to release the token into that. And so there's all that pent up demand from all those teams that got funded from the last cycle coming, plus all the new development that's happening in terms of teams really building. But then this cycle, you also have things like Pump.Fun that made new token issuance free and easy for anyone. And so now you have this just incredible flood of supply coming to the market, and there's just not enough capital there. And so it's really fallen on the funds to kind of hold up this market, if you would. But the total liquid funds for crypto is roughly 20 billion in terms of capital. And there's almost 40 billion in token unlocks coming alone, let alone new token supply. And there's just not enough capital there to support just the flood of these tokens coming. And that's why you see such high correlation in all this. Is these things are just, a lot of these things are traded with bots, a lot of the traded with just, market makers, and this market is all moving together. And this kind of goes to that crypto put that you mentioned there, which we call out. At the end of the day, a lot of these protocols are still venture investments, right? And so what that means is these are Series A, maybe Series B companies, and any venture investor will tell you that 90% of the portfolio goes to zero. Now, what you see with crypto is you have this thing where you can just launch a token. You don't need exit liquidity. You don't need like the markets to allow you to IPO. You don't need another marginal, a Series E, a Series F, whatever. That discipline that comes, and that next capital that says you have to have these certain KPIs. You need this users. You need this revenue. You need this growth in order to fund you. Instead, even if some of these projects have are absolute vaporware, they can just launch a token. And a lot of the times what you see is market makers will help push them up. Exchanges will want to push them up. And so these valuations you see a lot of the time are hundreds of millions or billions of dollars. And there's off like $16,000 of revenue. And it makes no sense, right? But that's because what you're really doing is you're launching the worthless, quote unquote, equity of a failed venture startup into a public market. And a lot of people, because a lot of it's still like bot driven and Twitter driven, and people that don't have much access to the information of the underlying projects, see these things and are happy to buy them. But what that means is almost all these tokens just trend to zero over time, aside from the ones that have the true teams, the true PMF, the true fundamentals that you actually want to invest in. And so that's a very difficult thing for the average investor to navigate in this space.
Yeah, for sure. I mean, one last question maybe that just came to mind now, because as you were explaining this, that you don't go into this or you don't answer this in the paper, but maybe I'd be curious on your about your view. a lot of people have been sort of calling for this altcoin season as well. It's just like with these alts, and as I understand you now, you're telling me like alt supply is like vastly oversupplied, so to say. Like maybe we're moving into a world of more capital scarcity. And then again, as you also said, like the COVID stimulus is waning off. So given all these sort of developments, I'd argue that all these people on X and whatnot were still sort of calling or even hoping for an alt season to come back. I mean, they just might be, caught off guard, right? That this is just never going to come back. It's like waiting for Godot, you're waiting for the alt season and it's never going to show up.
I would be shocked if we see that again. And I see no reason for there to be this other thing where every token just goes up, right? And like we saw flashes with Trump's election. Some things just went vertical for no reason whatsoever. And you saw this a little bit in March 24, which is these pop-offs. But where you're seeing it mostly is just in narratives. And you might see that still like over Christmas, this AI agent thing. Everyone was saying AI agents are the future. Therefore, this protocol that launched, 3 of them is worth $3 billion. And you saw like this kind of irrational exuberance around certain narratives. And you're probably going to see that happen from time to time. And so everyone right now, stable coins is what the excitement is. And so the moment X, Twitter cracks what the next stablecoin investment is, I bet you there's going to be some froth there, would be my guess. Or, and AI generally is probably the hot topic. But in terms of the average 50 million market cap, DeFi token that's an Aave fork on the 4th L2, there's no way that that's going to get a bid. And I think that's what they're trying to find that new DEX on that new L2 because it's 10% faster than this other L2. I just don't, there's just not enough capital and especially that marginal buyer now is aware of a lot of these dynamics. And you see almost like a populist revolt against all of these like high FTV coins, these VC backed coins. You're seeing that a little bit too. And I think all these things will start coming together to really stop that altcoin season from happening and be a lot more, there's gonna be a lot more dispersion. And admittedly, I thought it would happen earlier. It's taken longer for this dispersion to play out. And I think with the market structure bill coming in the US, the stablecoin bill, I think probably in 26, you'll start to see a lot more of this maturity come. But through 25, I don't see where any bull run comes.
No, that's actually a great point as well. I mean, in the end, it's probably, if you're really deep down in the trenches, so to say, and you can follow all these narratives, then maybe you have like short-lived alt season that you can take advantage of. But like, if you're not, and sort of you're just like this retail investor that comes along and dabbles their feet in crypto when Bitcoin is near the all-time high, then I think, this is never a good sort of point to join anyway. But even then, like it's probably not going to be this full-fledged, full-blown alt season that's coming along and pushing up every single boat, so to say. And that's definitely some great points there as well. Well, I mean, Kevin, we've gone almost an hour, so I think we'll leave it at that. Thanks a lot for sharing all these very valuable insights with us. Any last words from your side?
No, thanks for having me on. This is great. And just to summarize that is, I think you nailed that on the very last point. There is crypto has historically been this thing where put a little bit of money in, you get rewarded for it. I think now it's transitioned to a point where you have to be very, very careful in how you're navigating this, and do it in a very measured way because we're in a different regime now, especially as you mentioned, capital scarcity and all that. And so I just caution the average listener to, as you're navigating this stuff, to be very careful, really think through these things, underwrite them appropriately, and not just buy the top 10 coins because you heard about that on Reddit. And I think it's a big warning sign.
Yeah, for sure. Definitely a lot of alpha here. Thanks a lot, Kevin. Have a great one, and maybe talk to you at some other point again.
Sounds great. Thank you.
Bye.